Till now, we have discussed two widely used transmission channels to understand the impact of money supply on aggregate demand and supply framework. Let's now discuss another newly evolved transmission channel to broaden our understanding of the impact of the money supply on economic variables. This helps getting closer to the complex real-world situations as well, where all economies are integrated and therefore changes in one economy also change the other economy. This topic covers the impact of the money supply on the country's exchange rate, which in turn affects net exports and ultimately impacts the aggregate demand. Let's see how this interesting thing works. Assume that with the increase in money supply, the domestic interest rates get affected, that is, the previous exception condition, that is, liquidity trap, is not valid. As indicated earlier, this happens most of the times. Now, for an investor who is eyeing investing in deposits of two economies, A and B, if domestic real interest rates fall in economy A relative to the other, the investor would be more attracted to the deposits of economy B, right? Because he gets higher returns in the other economy now. So, he would rush to shift his investments from country A to country B. In the process, the currency of country A would depreciate vis-a-vis B, as now the investor demands the currency of B more than the currency of A. Remember the supply dynamics of the currency. So far, so good. Now, another cycle gets triggered in product and services market. The lower value of the currency of country A makes domestic goods cheaper than foreign goods, thereby causing a rise in net exports naturally, right? If price is low, the demand is higher. This in turn increases the aggregate output. Great, isn't it? One change leading to another, which in turn leads to third and so on. The schematic for the monetary transmission mechanism that operates through the exchange rate is: as money supply increases, interest rate decreases and exchange rate drops. Net exports rise and the aggregate demand increases. Great. Simple, isn't it? Let's proceed further. So far, we have focused our analysis of effects of money supply on only one asset price, the interest rate. However, are we saying that the money supply change affects only interest rate and that it does not impact any other assets such as stocks in the economy? No. Various economists have propounded other theories which suggest how the links with equity and other assets get triggered. Tobin's Q theory. James Tobin developed a theory referred to as a Tobin's Q theory that explains how monetary policy can affect the economy through its effects on the valuation of equities, that is, stock. Tobin defines Q as the market value of firms divided by the replacement cost of capital. If Q is high, the market price of firms is high relative to the replacement cost of capital, and new plant and equipment capital is cheap relative to the market value of firms. Companies can then issue stock and get a high price for it relative to the cost of the facilities and equipment they are buying. Investment spending will rise because firms can buy a lot of new investment goods with only a small issue of stock. Conversely, when Q is low, firms will not purchase new investment goods because the market value of firms is low relative to the cost of capital. The crux of this discussion is that a link exists between Tobin's Q and investment spending. But how might monetary policy affect stock prices? Quite simply, when monetary policy is expansionary, the money supply is high, which leads to lower interest rates and a decrease in opportunity cost of capital for firm. hence more net present value for the projects and company's future cash flows. This will lead to a higher Q, and thus higher investment spending I leads to the following transmission mechanism of monetary policy. As money supply increases, interest rate and opportunity cost of capital for firm decreases. In result, Q increases. Similarly, investment increases and also aggregate output increases. On the other hand, public finds that it has more money than it wants and so gets rid of it through spending. One place the public spends is in the stock market, increasing the demand for stocks and consequently raising their prices. Combining this with the fact that higher stock prices, that is PS, will lead to a higher Q and thus higher investment spending I leads to the following transmission mechanism of monetary policy. As money supply increases, price of stock increases. In result, Q increases, investment increases, and also aggregate output increases. Wealth effects. In their search for new monetary transmission mechanisms, researchers also looked at how consumers' balance sheets might affect their spending decisions. Franco Modigliani was the first to take this tack using his famous life cycle hypothesis of consumption. Consumption is spending by consumers on non-durable goods and services. It differs from consumer expenditure in that it does not include spending on consumer durables. The basic premise of Modigliani's theory is that consumers smooth out their consumption over time. Therefore, what determines consumption spending is the lifetime resources of consumers, not just today's income. An important component of consumers' lifetime resources is their financial wealth, a major component of which is common stocks. When stock prices rise, the value of financial wealth increases, thereby increasing the lifetime resources of consumers, and consumption should rise. Considering that, as we have seen, expansionary monetary policy can lead to a rise in stock prices, we now have another monetary transmission mechanism. As money supply increases, price of stocks increases, which increases wealth, and in result, consumption and aggregate output increases. The bank lending channel is based on the analysis which demonstrated that banks play a special role in the financial system because they are especially well suited to solve asymmetric information problems in credit markets. Because of banks' special role, certain borrowers will not have access to the credit markets unless they borrow from banks. As long as there is no perfect substitutability of retail bank deposits with other sources of funds, the bank lending channel of monetary transmission operates as follows. Expansionary monetary policy, which increases bank reserves and bank deposits, increases the quantity of bank loans available. Because many borrowers are dependent on bank loans to finance their activities, this increase in loans will cause investment and possibly consumer spending to rise. Schematically, the monetary policy effect is as money supply increases, bank deposits increase, in result, bank loans increase, which in turn increases investment and aggregate output. The lower the net worth of business firm, the more severe the adverse selection and moral hazard problems in lending to these firms. Lower net worth means that lenders in effect have less collateral for their loans, and so potential losses from adverse selection are higher. A decline in net worth, which raises the adverse selection problem, thus leads to decreased lending to finance investment spending. The lower net worth of businesses also increases the moral hazard problem because it means that owners have a lower equity stake in their firms, giving them more incentive to engage in risky investment projects. Since taking on riskier investment projects makes it more likely that lenders will not be paid back, a decrease in businesses' net worth leads to a decrease in lending and hence in investment spending. Monetary policy can affect firms' balance sheets in several ways. Expansionary monetary policy, that is, increase in money supply, causes a fall in interest rate, fall in opportunity cost, increase in net present value of firms' future cash flow, raises the net worth of firms, lowers the moral hazard problem, increases the bank lending, so leads to higher investment spending and aggregate demand. Another balance sheet channel operates through its effects on cash flow, the difference between cash receipts and cash expenditures. Expansionary monetary policy, which lowers nominal interest rates, also causes an improvement in firms' balance sheets because it raises cash flow. The rise in cash flow causes an improvement in the balance sheet because it increases the liquidity of the firm or household and thus makes it easier for lenders to know whether the firm or household will be able to pay its bills. The result is that adverse selection and moral hazard problems become less severe, leading to an increase in lending and economic activity. The following schematic describes this additional balance sheet channel. As money supply increases, interest rate decreases, which improves the balance sheet of the firm, which results in increase in lending and economic activity. A third balance sheet channel operates through monetary policy effects on the general price level. Because debt payments and labor contracts are contractually fixed in nominal terms, an unanticipated rise in the price level lowers the value of firms' liabilities in real terms, that is, decreases the burden of the debt and wages, but should not lower the real value of the firm's assets. Monetary expansion that leads to an unanticipated rise in the price level therefore raises real net worth, which lowers adverse selection and moral hazard problems, thereby leading to a rise in investment spending and aggregate output as in the following schematic. If, as a result of a bad income shock, consumers needed to sell their consumer durables or housing to raise money, they would expect a big loss because they could not get the full value of these assets in a distress sale. In contrast, if consumers held financial assets such as money in the bank, stocks, or bonds, they could easily sell them quickly for their full market value and raise the cash. Hence, if consumers expect a higher likelihood of finding themselves in financial distress, they would rather be holding fewer illiquid consumer durables or housing assets and more liquid financial assets. So, always there is a trade-off in holding between illiquid assets like consumer durables and liquid assets like financial assets. To decide on this, consumer balance sheet plays an important role in giving signal on likelihood of suffering from financial distress. During expansionary monetary policy, when stock prices rise, the value of financial assets rises as well. Then an estimate of likelihood of suffering financial distress lowers, which increases the consumer durable expenditure. End result, output increases. This leads to another transmission mechanism for monetary policy, operating through the link between money and stock prices. Following chart summarize the all discussed transmission mechanisms of monetary policy.